Maybe I'll come and I'll learn how much my firm is worth, and life will get even better still. Is that why you're here? Yeah, absolutely. Well, what a cool session. You saw the title. What am I worth? Right? Provocative. I can jump to the punchline and tell you the answer right away. You're worth the world to me. You're a wonderful snowflake. This beautiful snowflake of a firm that has so much value. And I'm not kidding around. Actually, my company's job, when we're representing sellers, is to understand each one of you uniquely, your strengths, your weaknesses, the characteristics of your organization, how to potentially position you with potential buyers, and how to also encourage you to articulate how you fit into their business model. And your ability to have that understanding of your capabilities, your strengths, your weaknesses, will actually improve the value of your firm. You can imagine each one of you right now, the person on your left will probably value you differently than the person on your right. It's subjective. Different organizations are going to look at you differently, and part of your job is to figure out how to best position yourself in the marketplace. So our goal, we have a wonderful panel that's going to be coming up. I'll be talking about the theoretical and what we see. They'll be talking about the actual transactions they do as well. Our collective goal is to help you get smarter on the fundamentals of valuation, to help you understand your worth and position you to go into the marketplace and optimize the value of your firm. And we got a great agenda to do it. I'm going to start by talking a little bit about some of the trends that I see in the industry, DeVoe & Co. sees in the industry, and then we're going to come up and we're going to have some Q&A amongst the three of us, and then we're going to open it up to you all for questions as well. Does that sound like a pretty good plan? Good stuff? All right. Well, let me tell you a little bit about myself. I've been in this industry about 20 years now. And I started by focusing on RIA M&A activity. I was at a major custodian in the strategy group, and M&A was just starting to become a potential pain point or opportunity for RIAs like yourselves. And 20 years ago, M&A was just getting started. We were seeing 20, 25 transactions a year. In today's environment, we see about 65 transactions per quarter. So it's up about 10x. And I go back this far too because there's an interesting trend that we saw in valuation. And to a high degree, it echoed what we saw with M&A activity. 20 years ago, it's starting to ramp up. M&A is happening more. Valuations are increasing. Matter of fact, valuations started skyrocketing up until about 2008. Anyone remember what happened? 2007, 2008? Yeah, a conspiracy of different factors drove the valuations of RIAs from the all-time high early in that year to the all-time low a couple months later. Had a profound impact on the value of each and every one of your firms. And then from that point, it took a couple years to methodically get back to normalcy. The markets cooled down. The players started coming back into the space. And we saw more sophisticated buyers coming into the space. Matter of fact, I would say in 2008, we saw irresponsible valuations that were happening in the marketplace. Remember the word bubble? We used to talk a lot about that. Tech bubble. We were seeing a bubble for RIA valuations. And over the course of the next 10, even 12 years, we saw valuations go from an all-time low to an all-time high yet again. And it actually eclipsed those high valuations that I just said in 2008 were irresponsible. It was a bubble. But this time it was different. This time valuations, despite being at and then eventually above what we saw in 2008, despite valuations being an all-time high in the industry, they were justifiable valuations. These valuations, despite being higher, had rationale behind them. And what is that? If you look at the buyers in the marketplace, we have sophisticated buyers that understand their business models. They've actually invested a lot of time and energy, and often a lot of capital, a lot of private equity is backing a lot of these firms. And they've created organizations where when they acquire your organization, they can improve the profitability of your firm and often make you grow faster. And if you can do a transaction and make a firm more profitable and or make a firm grow faster, you can pay a higher and higher premium. So this is one of the key factors that's driven up valuations. Another one is private equity arbitrage that we'll be talking about as well. But in today's environment, we're now at 3 years of record high valuations that we've seen in the industry. Now that's despite some perfect storm that we've seen as well. Market volatility drives down valuation. Market declines drives down valuations. Interest rates, pretty high, highest they've ever been. There's a number of different factors that could and potentially should be driving down valuations, yet they've continued to maintain this high level of value in the marketplace. So that'll kick us off. Now please allow me to introduce my two panelists. Come on up here. And give both Denitsa and Kaylin a warm round of applause. Come on up here. All right, we went with sunglasses today. It looks like you guys did too. Denitsa, why don't you get us started? Tell us a little bit about yourself and your organization.
Great. Hi, everyone. Denitsa Balunis. I lead enterprise strategy at Edelman Financial Engines. Edelman Financial Engines is an RIA, a mega RIA, or a meta RIA, as Dave DeVoe likes to call us. We have about $300 billion under management, 65 of which is traditional wealth management, personal wealth. And the rest of it is institutional 401k business. We have been in our current shape since 2018 when we put together Rick Edelman's company, very planner-focused, very human-based planning approach, with a company called Financial Engines, which was founded by Nobel Prize winner Bill Sharp, that really focused on investment management and technology and bringing that together in order to serve as many people as possible. So where we sit today, we'd like to say we are a truly scalable RIA. But for the purposes of this discussion, my background, in 6.5 years, we've gone through several transactions. So I have been on the sell side twice. We have brought in a couple of private equity investors in the last 6.5 years. And I've also been on the buy side, where I lead the M&A team, and we've brought in 8 firms worth about $5 billion in the last 3 years as well. So very excited to share any insights and learnings that I've had throughout that process with you all.
Yeah, and it's quite an organization. I'm honored to have the former president of Edelman work at DeVoe & Company. He was employee number 6. And then president, grew it to over $200 billion, then the team ran with it. And I'll tell you, it's fascinating too. The Edelman Financial Engines organization has truly done just about every transaction out there. Early on, they were one of the first firms to take on private equity, and their firm performed so well, they actually absorbed the private equity firm that invested in them, and they took it over. Later, started doing more transactions, went public, more private equity went private, merged with Financial Engines. It's just an incredible story, and it's so great to have you here, not only the head of M&A, but also the head of strategy. So lots of rich conversations to come. Kaylin, tell us about your background as well as the organization.
Sure. Thanks, David. Kaylin Mayhew, president of Merit Financial. So we are a RIA that is based out of Atlanta, but with offices throughout the U.S. I think we've got 45 offices, around $13 billion, 100 or so advisors. A little bit of background on me. It's interesting when we talk about valuations and M&A. So I've been a seller, and I sit on the serial acquirer side now. And so I've personally been a part of 37 transactions, including my own. And I know we were talking about ownership structure here. And so one of the differentiating factors that I think we have right now is that we're over 70% employee, leader, advisor owned. So it's interesting to be in this space where there's good on all different types. So it's fun to be up here with some diversity when you look at size and company structure.
Yeah, absolutely. I mean, such an incredible story, too. The rich experience, 37 transactions over the last how many years?
3.5.
3.5. Just crazy. But also a unique element, too, that we'll get into more detail on. We'll be talking about a whole variety of different things that are affecting valuation. Private equity is surely affecting valuation as well. And this is a unique element where it's private equity backed, but as you just heard, minority stake within that organization. It's an employee-run and owned organization, 70% of the equity being owned by the employees and the shareholders of the firm. So very exciting stuff. All right, well, let's get started. You both are way younger than me, so I may have gone way too far back to talk about some of the trends in the industry. But any reactions to that arc, if you could hear it off the stage, of what we've seen with the trends as well?
I've actually been in the industry longer than you, David.
Come
when you
on.
stood up here 20 years, yeah, I think
you-
that this is like 28 for me.
Well, I got to drink the water you're drinking because you look so
I was
much
going to
better.
say, you
than
must
me.
have started when you're 5.
Well, tell me about it. Any thoughts on the trends of what we've seen in the industry over the last 2 decades or longer or more recently?
Specifically on valuations and M&A. So this is such an exciting time. I can remember when you would go to a valuation session or anybody talking about succession solutions, and it was this revenue-based multiple. Anybody remember what they used to say? What is it, like two
times revenue.
2.5 times? We were getting excited about that. And we've really professionalized our industry. It's like what we do is a noble profession. And so now people are actually smart money sees that. So congratulations to you all. It's amazing that we're at this place. Now you were talking about, I call it stupid money. So you said foolish valuations or what was the, yeah, there are situations where there's that stupid money out there. If you can find it, great, go for it. But I think where we're at and where we've seen the valuations, you're going to get a premium for a premium business. You really are. And what's a premium to me at Merit may not be a premium to someone else and vice versa. So it is interesting to see where your business fits in best. Things like geography can be really important. I had a great question from someone. I don't know if Alec is in the audience. Okay. And he brought up a great question. He said, what about the next gen that hasn't been equitized? Like, how are you handling that? I can tell you your business is more valuable if you've equitized that next gen talent, because guess what has to happen on our side of the equation? We have to equitize them. And so we're going to be thinking through those type of things as we're looking at this. But it's such an exciting time to be in this industry, and that need to do a transaction for succession because you want to golf 8 days a week or whatever your passion is. The exciting thing is it's these partnerships where we're coming together to serve the client better. It's not just some check to walk out into the sunset. That's what gets me jazzed.
Yeah, and a couple threads that'll pull from that. Covered a lot of great ground really quickly and a few headlines too, especially if you're taking notes on optimizing the value of the firm. Something a little unusual, she said, hey, if you have a succession plan in place, then your firm's actually more valuable. Often folks are thinking, hey, I'm going to sell internally. That's a discussion we'll have in a couple of minutes. Or I could sell externally. It shouldn't necessarily be an or. If it's an and you sell equity internally, you start to migrate that management, that leadership of your organization, the value of your company will go up. And sophisticated buyers often won't even talk to you unless you have that succession plan in place. Denitza, please.
I think that's true, but as Kaylin mentioned, different buyers also value different things. And so for us, for example, as a large organization, we have over 330 planners who have been, some of them have been with us for a long, long time. And so we actually look at firms that don't have succession plans because we have a very established program where we do succession planning and we have transitioned successfully founders or planners of our own. And so to us,
do you
that's something
discount them on evaluation metrics? Because we do as well, and we have a lower tier, lower schedule. So that's interesting.
Not really. I think that what we look at is actually the client base and whether as the client base ages, is there a multi-generational relationship there? So whether that's with the lead advisor or G2, that's where if that is not in place, that's where we do discount. But just succession is something that we do pretty successfully, and so we don't discount on that.
Yeah, let's talk about that a little bit. And you've even seen it momentarily. One firm with a certain set of characteristics worth more to one buyer versus another, versus another, versus another, if we had 5 other people on stage. So a few thoughts. A lot of firms in the audience or here at this event are too small to have a successor, for lack of a better word, or they've gotten a lot bigger, but they never put that plan in place. I think Edelman Financial Engines and other organizations that have designed models that enable you to sell your company as a sole practitioner have a plan to exit is critical for the health of this industry. We're going to have literally thousands of firms that are under 100 million. They could be 200 more or more, and they don't have a successor in place. And we need even more organizations like Edelman where their business model is not just going to buy those firms for the heck of it, but really transition those clients over. Is that a good way to talk about how your model works with those exiting advisors?
Yes, we do that very successfully, and so yes, just our size and scale affords us to do more of that, just as well as we do also grow, advisors who are earlier in their career and looking to grow as well. And so again, we tend to do both.
I love sharing about the successes, but I also love sharing about our mistakes because I hope it may help you all. And so if you are in this session because you are thinking about buying your first business, word of caution, geography means a lot if you're going to do a succession play. So we attempted our first 4 transactions together after I merged in with Merit were out of our scope where we had leadership, where we had an office, and you can drive yourself to an early grave if you don't have that leader in place. And so if you're looking to make an acquisition and you're out in California and that opportunity's in Florida and you love it, I would just strongly caution you to think about the lifestyle and think about leading a team and serving those clients well from a distance. It's just really, really challenging. And there's just too many great opportunities in your backyard. I mean, unless you're in the middle of, where would it be, like South Dakota? Anybody from South Dakota? Hopefully I'm not offending you. But when you look at a heat map, there should be plenty of folks right around you. I would stay really tight to the geography that you want, unless that has been a virtual team and those clients have been used to being served virtually.
Yeah, so a couple thoughts. Both as a seller as well as a buyer, methodically thinking through what you seek to achieve, your business model, what makes sense, and then starting to have clarity and even conviction around the profile of a good seller or buyer, depending on the situation, is paramount to having a successful transaction. And I think it'd be great, everyone do it yourself, et cetera, but it'd be valuable for each one of you to talk a little bit about the characteristics of an ideal seller for your organization and perhaps elaborate, too, why that works best for an organization like Edelman Financial Engines or Merit. Characteristics of the optimal seller for you.
Optimal seller. So we are generally looking for teams that, both are working well together. So as, just word of caution, there are some firms out there that team up with other firms then to increase their size and likely get a higher multiple. And so we
call that smoke and mirrors. It doesn't work.
So we stay away from firms like that. But what we're looking for is are cohesive teams that have built expertise in areas where we can, as a company, invest in order to extrapolate over a broader planner base. And so firms we've acquired have, our tax practice came through a firm that we acquired. The leader in our investment management integration for all the firms that we acquire was a CIO of one of the firms that we've acquired. We have portfolios that have come in through our organizations that are now used across the board by 300 plus planners. They have come from firms that we've acquired. And so we're looking for talent, we're looking for capabilities. And also, as we work with about 800 large employers out there whose employees, we manage their 401k plans. They also are looking to become our wealth planning clients as well. And so there's certain industry concentrations that we look for, such as tech, healthcare, aerospace and defense, that we have large employers in, where that expertise, airlines, where that expertise is something that, one, we can help those firms grow because of our workplace presence, but also, they can help us because some of these employees have their special needs. And so really looking for to add additional value to those high multiples that are in the industry so that we can both benefit.
Yeah, and I'll elaborate briefly, and then I want to hear from Kaylin as well. The potential power of strategy and strategic fit is huge. So if you look at Edelman, who, was an RIA, a huge RIA, with a charismatic leader, very passionate about what he's doing. And Financial Engines, which was arguably one of the largest retirement firms in the country, with relationships with all these huge firms across the country, those coming together unlock value and power because suddenly you have advisors that can support those major retirement relationships. Two other examples: we've sold Edelman two firms. One was, I think, $300 million, and one was about $2 billion. And this one is an example too of sometimes an awareness of your weaknesses doesn't necessarily mean you're going to have your valuation eroded. So in one case, we sold a firm where the guy's just charismatic salesperson, grows like crazy, et cetera. Maybe not as great as running the day-to-day operations. So to join an organization like Edelman, where those responsibilities, Edelman Financial Engines, I'll break my habit here, EFE, enables that person to take all these administrative headaches, all these operational headaches off his plate, and he's able to go grow that business more aggressively as well. So part of the value proposition of these organizations and others is that power of scale. Power of scale. So, Caitlin, tell us a little bit about your optimal seller.
Yeah, so it's evolved, and we learned the hard way on just doing the succession plans. That didn't work, and so I'll put it into three different categories. We have a talent crisis in this industry. We do. There's just not enough next-gen talent that's coming up, and so we're looking for that amazing team, and we're looking for that leadership. So someone that has that entrepreneurial spirit, wants to have their hands all over it, wants fingerprints, doesn't necessarily want to hand over the keys and have to get into one size fits all, must get in this bucket. So that's one. The second one is growers, people that just love to grow the business. They love the organic growth side of this business, and they want to forget all the rest, just like you were describing. Like, forget that business stuff, SEC, I don't want to think about my ADV again, like those type of people that just want to grow and put their head down. It's like, come on. And then the third one would be that succession, but we only do the succession if we have leadership that they're going to plug in under, because it's just not scalable if you don't have that strong platform to build on.
Good. So great insights. If you're curious on these two firms, fantastic. You get a better idea. But perhaps more importantly, too, just understanding the clarity that they have around who is a good fit. We were just talking about the time and energy we have to invest in things, and your ability to be super targeted in who's a good fit, whether it's a buyer or seller you're looking for, is going to really enable you to go out and run your day job as well as find that perfect fit. All right, I'm going to talk about some valuation techniques, right? And we heard about them in passing. I'll articulate them, and then I'm going to open it up to you guys, and you can say how you actually value these firms in the marketplace. So, oversimplifying valuation, there's really three key ways to value an organization. There's book value, pretty much irrelevant to this industry. Your computers and phones are worth a negligible amount of that firm, so that one you can throw away. The other one is what's called comparables. 2 times revenue, 7 times cash flow, these types of things. Now, one might say, gee, Dave, that sounds like a pretty good way to value firms, because guys way smarter than you, Dave DeVoe, you use PE ratios, and gee, that's proof of concept on how this multiple approach can be valued, can be valuable. However, I will argue that these multiples are very blunt instruments. So multiple of revenue, extremely blunt. Who cares about the revenue? We care about profitability, EBITDA, right? But even if you're looking at the EBITDA part of the equation, you just don't have great insights into the details of this firm to be able to compare it like you do a PE ratio amongst other firms. So there's a blunt instrument to a high degree with multiples of cash flow, and it's easy to talk about on stage, but you'll hear momentarily whether they use that or not.
Dave, they might be curious as far as that definition of cash flow, because so you hear multiples, right? You hear 12, 15, 20. You hear these crazy multiples. But when you dig into the information, and we happen to have some friends in really great places like Dave that will give us intel into what is that multiple of? Because it's a moving target for sure. What are firms going to add back? What are they going to put in your plans? So do you want to? Yeah,
absolutely. A joke too is I talk to firms that have sold to private equity, and I'm like, hey, what's the multiple? What's going on? Well, it depends on what cash flow number you use, So we will go to the marketplace. We'll package up a seller, constructively think through the characteristics of this organization, how they could be a great fit for this firm or that, or several firms, et cetera. And we'll also do pro forma analysis on what their economics are. And we might take it to Denitza, and she looks at that, and her, LOI is based on that cash flow number. And Kaylin may tear it apart and say, wait a sec, we're gonna add this out, we're gonna back this out, we're gonna change this economic element. So a big part of the equation is as you go to the market and you talk about what your profitability or cash flow is, you wanna have a defensible rationale for how you're calculating it that way.
Yeah, and so we do use EBITDA multiples. And one thing, if you guys are considering, if you're a seller and you're currently, an owner of a firm, one of the key levers that we see people using is owner salaries. And so how much are you going to agree, like, what you make today, how much are you going to agree to make going forward in order to sell your firm? And so there's an inclination there to, we call it padding your EBITDA. So really, you make $1 million today, and then tomorrow you say you're going to make $100,000. And it's, makes a huge difference to the EBITDA calculation, but it's really not realistic. And I think one of the things we do is we kind of reverse that back, because we know that if you take a 90% pay cut, you likely, even if you think it's okay today, you likely a year or two down the line, you're not going to be happy about that. So as you think about on the buyer side, always pay attention to that, but on the seller side, just be realistic with what you're willing to take. Some of it is it's the multiples and the EBITDA numbers could get, that could get into a race of its own, but just be rational and just know yourself and know your expenses and what your situation is.
David, should we talk about like minority versus complete?
So,
I mean, I know that wasn't on the list of questions, but I can imagine, and I am like the hypocrite here, because here I am over at Merit, and we took on a minority investor, but we don't do minority investments into other firms. Now, there's all kinds of reasons for that. So I think that size does matter when you look at minority versus majority. So do you want to talk about the trends on that?
Yeah, a couple quickies. I want to close the loop because I talked about 3 different techniques: book value irrelevant, multiples, which can be a blend instrument, and then discounted cash flow is really the best way to value a firm. Matter of fact, how many of you are contemplating selling internally? Okay, a couple of you. Yeah, ideally you're going to methodically, do a discounted cash flow, which is looking at your history, nerding out. You're either doing a lot of modeling or you're hiring a firm like ours to come in and start to project into the future what's going to happen with this organization. Ideally, you're going line item by line item to think about what's going to happen in the future, and then you're discounting those back to present day. The cool thing about it too is you're really creating a mini business plan for your organization. You know when you're going to need to expand office space or hire a new person because you now have 106 clients per advisor and your target is 85, et cetera. So it becomes this elegant plan. But internally, there's so much value and power in having your G2 as part of this. When you're selling your firm, you're really selling your life's work, right? So you want to get that number right. You want to optimize that number. If it's internal, you want it fair as well. And when you think about G2 or G3 buying into your organization, they're really putting their life savings in play here, right? So you want to make sure that everyone has a fair valuation, and ideally they understand how to run your company as well as part of that process. Yeah, there's a couple quickies. There's premiums of what a firm might be worth, and there's discounts for what might occur as well. Matter of fact, both of these organizations are what we consider meta RIAs. They're using the most effective tactics available to run their companies. This is a online gaming thing that I heard from my son. Ninjas, meta. But these companies are really, they have sophisticated management teams that are backed by often private equity, almost unlimited access to capital. They're differentiating their models, and they're really creating a long-term industrial strength organization. Because of that, and because of the potential arbitrage for private equity too, these firms can typically pay more than the firm sitting next to you, the audience member on your right or left. If you're not an RIA that can unlock that value and power, make a firm grow faster or more profitable, then you probably can't get into these valuations. Now, we'll talk about maximizing valuation or optimizing valuation, and numbers shouldn't be the only thing you do, but tell us a little bit more about minority discounts or other premiums you see in the marketplace.
Well, and Dave, as you were talking as far as the valuations, I think the other aspect of this is, so in our, remember I had 3 as far as ways that we partner on the growth side and the leadership side and that team side. We have equity that we're trading as part of that transaction. And so you really need to be thinking about not what your valuation is now, but what you can do. And I feel like I should have a disclosure that says like past performance is blah, 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 as far as compliance. But we have had people that have taken 50% off the table, and within 2.5 years, their value is back to where it was just because of the increase that we have seen in stock. So I think it would be important for people that are planning on selling and staying, and I hate the word selling because that sounds like, I don't know, you're partnering. We call it partnerships. And so if you're thinking about doing a transaction and staying, really get into the financials and that reverse diligence process, which someone obviously like DeVoe and some of the other folks out there will help you think through.
Well, you touched on something really important that I'll elaborate on quickly. You know, there's a joke in the industry, which is like, hey, I'll give you any valuation you want as long as I can set the terms. So valuation's sexy, it's shiny, everyone focuses on it, reporters, but the deal structure is equally important. So Reader's Digest, there's typically going to be a down payment or, payment at close. Could be 50%, could be more, could be less, went up to 70% for a while. And then there's going to be, a whole myriad of different deal structure factors, but 2 major ones are often the retention of clients. You want to write a check and make sure the clients are going to stick around. You're getting what you paid for. So that retention element, as well as potentially a growth component as well. Gee, you say you're going to grow like crazy. You've dazzled me with how great you are at growth. All right, are you going to put your money where your mouth is? Are we going to have that growth trajectory as a contingent? And there's no shame to say, hey, I don't want to have a growth component, or no, I want to actually optimize the value of our firm. So that's the overall basics of the deal structure. And then, as Kaylin was just alluding to, it can be cash, it can be equity. How much cash do you want in the organization? How much equity? Denitza, maybe you can talk a little bit about that cash versus equity ratio that you folks have and how that might have changed over time.
Yeah, so the majority of the deals we've done are cash deals. Our business generates a lot of cash, and as Kaylin mentioned, equity is actually one of the most valuable things we have. And so we do use it in transactions, but again, we are private equity owned, and our equity isn't liquid. And so what we're looking for there is making sure we have alignment with the people who join us, who really are partaking in that equity, are staying with us for the long term. And ever since we've more than doubled our value in the last 6 or so years since I've been here. And so again, it's a very valuable thing to do. And so we do use it for select deals, for specifically not for those, usually in succession deals, we use it for the G2 and when we really want to make sure that team stays. But the majority of the transactions we have done, specifically with firms where the owners are looking to move away from the business after a time, has been cash. So we can afford to do both, and we do use equity, judiciously.
So, and you'll even see, and by the way, I don't know if there's a way to trigger questions that we might have. I have a ton, I can keep going, but for whoever's behind the scenes, if there's this question prompt, let us know, and we can get to those questions as well. But you'll even see in the life cycle of an organization that the value of the equity in the firm will ebb and flow. Matter of fact, in some cases, an organization wants to spend more cash. In other cases, as they're moving toward or away from a capital raise, they want to do more equity. So this is something that will rise and fall throughout the life cycle. So apparently, this is a way to ask a question.
But it's not up for them. It's only up for us.
Oh,
Maybe it's on the other side here.
Right.
I don't know. It's a Slido. All right, we can do it old-fashioned way.
Well, here.
Oh, there we go. There we
got
go.
it. It's starting
up.
to come.
It's up.
All right, it's up there. Okay. Can you give examples of innovative deal structures or earnouts that are becoming more common in advisor acquisitions?
Oh, I love this. So we had to do this when the market took a little dip. And so When you look at, there's a couple of bites of the apple in our typical deal structure for the people that are staying and growing with us. So we have an additional, let's just call it a turn on the EBITDA, or sometimes it can be more than that, that we look at it at that 2-year time frame and see how much, and it's almost, it pains me a little bit because we put so much effort and money into the organic growth that they're kind of plugging into our engine that's already running, and then we're paying them again for that. But to get the right people, I don't mind it as much as I would rather just kind of silo what they're able to do on their own, but we want them to be on board. So I think that is one of the ways. The other way is we've got a way to, because we have grown a lot through mergers and acquisitions of introductions. Like I think 90% of the transactions that we've done have been self-sourced, people that we know or we're 1 degree away from them. And in those scenarios, we have a way to pay that finder some additional compensation and almost deal structure on top of that.
Yeah, I think the growth earnout is probably where we also flex the most, as well as the retention earnout. So there was, I think, when we first started this, a very set structure of like, 50-60% up front, and then something at based on retention. We changed that based on who the firm is. And so if you're a fast-growing firm, probably you're going to get less in retention earnout. And then as you increase your growth potential, and again, depending on kind of the firm you are, and you, specifically if there's a firm that has done a lot of M&A in the past, then we bake additional M&A, us funding additional M&A that you would do into the growth earnout in order to just really take advantage of that capability that you have built. So those are a couple of the things we've changed recently.
Yeah, it was interesting, when the stock market declined a couple years ago, a lot of the active buyers started shifting their deal structure. And at first, it seemed like they were shifting it in the wrong direction, because we had moved to an industry where it was like up to 70 or 80% down. DeVoe & Co. had done deals that were literally 100%, cash at closing or consideration at closing. And also the earnout structure went from 5 years to 4 to 3 to 2. And then when the stock market became volatile and declined, we saw the buyers stretch out that earnout structure, which was intentionally to provide the sellers with the opportunity for the market to come back. To say, hey, we all know it's going to come back. You want to do 3 years, you want to do 4 years. And I think it's a testament to a lot of the sophisticated buyers in the marketplace that they were, really catering and refining their deal structure to enable all parties to win. These aren't slimy private equity New York firms that are coming in to make a buck and get out, et cetera. The buyers in today's marketplace are really part of the ecosystem and part of the REA community. So good players out there. Okay, we got another one up here. Kaylin, can you unpack minority versus majority investment valuation variance?
Yeah, so I don't think that there's much variance anymore. There used to be. I really don't think that we're seeing a huge difference. I think it's the players that are willing to play in the minority and what they're doing. And so I can remember, because I've sat in that seller's shoes, and I had some opportunities for a minority investor, because I had a partner that was retiring, and I was going to look at, we had planned an internal succession, had a great team, and I looked at that minority, and basically what they were offering was very limited. And I know that there's some other players out there since I took a look at this, so I don't want to generalize. But are you going to give your full attention to something if you own some fraction of it, some 10%, some 20%, some 25%? Are you going to give it the same attention that you would if you owned 100% of it and you guys were on? And I believe what our industry lacks is collaboration and is community. I think we've been built by, the wirehouse mentality, to where everybody's keeping their notebooks close and what's working for them, they're not going to tell anybody. And so when you can create a culture of collaboration and true team, it's just, we're so passionate about that. But I did say I'm a hypocrite, because we weren't ready to hand over the keys, and that's why we went minority. So that's why, if you've got that already and you've got that ability and you don't really need all of that support, then go for it. Find the minority partner for you, take their money and use them for what you can, and then just go build.
Well, and a couple thoughts on that, just being the nerd. Why would a discount occur with a minority investor or investment? It's because you don't have control over that organization, right? If the CEO starts running this company into a ditch, you can't really grab the steering wheel. You don't have control over when a liquidity event might occur as well. So that lack of control typically has a discount for that minority position. Now, buyer beware too. Like, there's a number of different minority players in the marketplace. We can argue whether there's a discount or not in many places. But another joke, sorry, this is like the third M&A joke, is some of those models are set up so that folks are saying, hey, you're selling a minority stake, but you're giving up majority control. You really got to read the details of this. It's not just, hey, minority, and I'm running the business however I want. You know, you really got to probe and look at the details of that because it can have a profound impact, not only on your business, but frankly on your life as well. Okay, what red flags do acquirers typically look for that might negatively affect a business valuation?
High margins. Someone that's trying to say that they're running their business at like an
You're not going to pay for 80%, 85% margins? Come on. What's going on?
No. I would say it all depends upon the size, but if the margins that are being presented, and there's some people out there in the banker world that will get these sims and it will show us that you've got a $2 billion business running on a 69% margin or something like that. And I'm like, there's just no way. We know what it costs to run a business if you're serving your clients and your advisors well. And so I think that that's one of the huge red flags that we don't even entertain the conversation.
Yep.
I think there's some intangibles too, so not including your G2 in conversations, not really having a lot of, firm participation, things like, that could be a red flag that actually makes you walk away from the deal, as well as client loss, asset loss. Again, not growing is probably okay if you're just swamped, but if you start losing clients and assets, that's a red flag that we look into.
Piece of advice on that as far as like getting into the team. So we didn't do this one time, and I wish we had, and now we do it, to where we have an independent firm that comes and does a 360 on the teams. And so they're going to get that extraction. I'll give you an example. A father-son team had built a great business, I think it was like a team of like 12, 13 people. On paper, it looked amazing. We did the 360, and we found out that dad and son fight like crazy, and it's like this toxic environment. There had been a bunch of turnover. So guess what we did? We bowed out of that. And so hire that firm, pay whatever it is. I think it's like $6,000. I mean, it's the best $6,000 that you could ever spend if you're looking to acquire a firm.
Yeah, lack of internal cohesion can really break your deal. And so, yes, that's something that is a big red flag.
So I want to go to the other end of the continuum, but key takeaway there. Buyers don't want to buy problems. If you have problems within your organization, fix them before you try to sell. But let's go to the other side. We've got a great audience. They're running great organizations. They want to optimize the value of their firm. Any advice to them in terms of how to optimize the value of the firm, what to focus on, when to focus on it?
I think one of the pieces of advice I recently heard that I really like was decide what you want to do. Are you looking to transition, or you're looking to grow the business and invest in that? So if you're looking to transition, then just make sure that you run the business in its current form in the best way possible. If you're looking to grow, just invest in growth. And those are two different, again, if you are looking to sell or partner with someone down the line, those are different buyers that you would look for in different ways that you would position your firm.
I think it's, when you look at the numbers, if you're talking specifically about just the financials, I'll walk you through a couple of mistakes I've seen. Overhiring. So if you think I'm going to just have this amazing team, or maybe you're at a place where you're really lifestyling the business, and so you need to hire a bunch of people so you don't have to do it anymore, plan an internal succession in those scenarios, because you're not going to get, and I look at our two biggest expenses are human capital and real estate. And so just be making smart investments, but don't postpone it. Like, don't stretch your system to the place where it's about to break, because if you come on board, if we bring you on board, we've just placed a valuation on that business, and then day 2, you're coming and saying, oh, we need to hire this person and this person and this person. We're going to say, Well, wait a second. It's going to come up in diligence with a firm that does this and does it well. So I would size right your team, and then also you're looking at a blip. So there's 2 time periods that we take a look at. You can look at trailing 12, and you can look at run rate, which is quarterly. So as you're getting closer and closer to that valuation point, be careful, make wise decisions, and then also do a good look at what you can add back. So if you've got your car, if you're taking your family on vacation, that's great. I'm sure the IRS is not here. They don't care. I mean, they care. I don't care about that. But so you have that add back opportunity to point out the expenses that won't be on the other side.
Well, I'll tell you what, like, we're debating just knocking the rest 2 hours out of your day and going on, but we have to stop. I have to tell you, I've been doing this for 20 years. Every time I get on a panel with smart people, I learn a little more. We heard Kaylin talking about people. We're nerding out. We're talking about valuation here, very technical stuff. But at the end of the day, a very sophisticated buyer here is saying, hey, your people are really important. What's happening with your people, the organization, how they work together. And we also have Denitsa, no shock, head of strategy at Edelman Financial Engines, as well as corporate strategy, and talking about the strategic power, right? Again, technical valuation, et cetera. But if you can make a case that your organization merging into another company is going to unlock value and power, it's going to be worth more and more. So please join me in thanking my panelists. Thank you so much, folks.